Well, the financial results of South Africa's big four banks for the 6 months ended December are positive reflection of the financial health of the industry, despite the recent global economic uncertainty. Here to join us for an analysis of the major banks is Johannes Grosskopf. He is from Banking and Capital Markets, PwC. A very warm welcome to you. Hi. Well, let's just talk a little bit about these numbers. Combined headline earnings up 17.7%, and main driver of earnings growth being the containment of those costs and also just a reduction in impairment charges. What does this picture tell us of what's happening with the South African banks right now?
I think it's a very credible set of results, as you've said in the introduction. I think if you look at it, combined headline earnings, 40 billion rand industry, the big four banks, it's a massive industry, and they've focused heavily on costs. So cost containment is only up 2% odd year on year, which is really credible in an inflation environment of a lot higher than that. So that, I think, is the one lever that's clearly been pulled. The next lever has been pulled is on focusing on margin, maintaining margin income whilst we're in a low interest rate environment. So I think the banks have done extremely well in protecting their margins, and we can talk about that a little bit later. And then I think it's, as you said, it's impairment charges have come down, and clearly we've been at a low interest rate environment for the last 5 quarters now, and the rate has stayed the same, and that's spilled over to the consumer, which has allowed banks to really plow back some of the NPLs that's been in their portfolios, and therefore impairment charges have come down.
I do want to talk about those margins. One of the things in the report was that banks now it's going to be very interesting to see how they defend those margins. When it just comes to strategies, what do you see the banks doing, particularly the four?
Yeah, so banks have got a number of strategies. You can reprice on the asset side, and B, on the liability side, it's clearly manage that, and then also from a hedging perspective. So a number of the banks have got significant cash flow hedges in place to protect their margin in this environment. Secondly, we've seen in repricing on the asset side that banks have looked at their risk appetite and pricing more appropriately for that risk. So I think that's been very positive.
When it comes to that risk, it seems as though where the money is, and it seems the growth, a lot of it coming from the unsecured lending market, and that major banks are growing their presence there. And just looking at a report from the NCR recently, Consumers Credit Market Report showing that unsecured credit granted is increasing at about 59%, and credit facilities growing even faster at about 69%, and secured lending in mortgages extending only 15%, and other secured credit at only 22%. So I mean, those numbers just show that the unsecured lending space seems to be quite a lucrative place for the banks to be right now.
Yeah, I think so, and you've seen from all the bank strategies that they're tapping on the unbanked market. We've seen non-traditional branches opening up around the country to be able to access those markets and to give access to those individuals. But what one also got to say is that it's still a very small portion of the overall loan books. If one looks at unsecured lending compared to vehicle and asset finance or secured home loan financing and corporates, it's very small still, but clearly a growing area, and something that banks are monitoring very closely.
When it comes to that, though, I mean, just looking at the numbers that I threw out there, you know, just how much, I mean, it's a huge difference, you know, between the secured and the unsecured in terms of growth. Do you think that the banks are going to probably be competing more on that, or would you think that you know, banks are probably going to look at growing the clients that they have, you know, and just probably seeking to increase what they do have right now?
No, I think it's definitely looking at the unbanked market. How do you access them? Is that through electronic channels, mobile channels, and how do you access them? How do you give finance to those individuals? And clearly increasing the pool of funds available to them. However, there's risk appetite, and banks will price for that risk.
Let's just talk a little bit about competition, and the reason I'm talking a lot about the unsecured market, because it seems as there's a lot of interest there. When it just comes to the amount of competition, not just from banks, other digital players going into that market, do you think it's going to make it much more difficult for the banks, or do you think that they have, you know, in terms of just being more established, are going to be able to capitalize more on those opportunities than new players?
I think you've got to look at it in 2 ways. So there's the transactional element, and then there's the lending element of that. Now, on the lending element is not only the banks, you've got the retailers that operate in that environment as well. So you've got competition at that level. You've got on the banking level, We've seen the other banks, Capitec, Able, that's not subject to this analysis, but they've been very well established in those markets. So the competition in that area is strong. I think then from a transactional perspective, you mentioned digital players. It'll be interesting. I always say it'll be interesting to see whether Facebook, iTunes, Apple, Twitter, who becomes the next retail bank and can reach out to their consumers.
Let's talk about average return on equity. That was up 16%, and these the return on equity levels remain lower than pre-crisis levels. When do you think we could return to the levels pre-crisis, but also factoring in all the regulation reform that has come in now?
I think all the banks have said to their analysts and to their shareholders that the levels of ROE pre-crisis is not going to be seen for a very long time, and that's echoed internationally as well, particularly for the reason that you've just mentioned. It is on regulation. So Basel III is going to require a lot more capital, particularly on trading books. That's come in 1st of January. There's a lot of uncertainty still on a number of regulations that need to be implemented, and banks are cautious in holding capital buffers for that. And we've seen in the result presentations varying degrees of what the impact will be on the specific banks, and it depends on their position in the market at the moment.
Let's just talk about some of the strategies that we do see the banks going into, and that is expanding into the rest of Africa. That a lot of growth coming from that, and we have seen some aggressive movements by the banks going into Africa. Who are the winners going to be in terms of operating in the rest of Africa? Because the rest of Africa is a very different market to what South Africa is.
Yeah, I think you'll see that our banks is not the only banks there. You've got established players like Standard Chartered that's already in that market, and you've got some local players that pretty big as well. I think the winners will be those that can implement the strategy best. You've got, on the one hand, expansion costs, and on the other hand, maintaining an ROE level that's acceptable to your shareholders. And the bank that can maintain that ROE level whilst expanding in Africa will clearly do very well for themselves.